Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinion as we go through it. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these sectors and topics, looking for potential investment opportunities. I found a bunch, looking at a bunch of different sectors. Most of them are related to commodities because that is where the value is at in the market right now. Starting with myself, Finding Value Finance, Platinum short-term breakout, and still need to break out on the longer term. Looks really good. This is kind of from a multi-year view, maybe about 5 years. We've been consolidating sideways. We've got the upper trend line that resistance line that we're trying to break. We've broken the downward facing falling wedge to the upside here. The next one is trying to break through this upper trend line. And hopefully that can spur a big move to the upside for platinum. Platinum is the cheapest metal of the group. It is cheap against gold. It is cheap against palladium, and it is cheap against rhodium and silver. The ratio charts are screaming that platinum should be a good deal. Now, platinum works under a little bit different market condition. It's not the same as gold. It's not the same as silver. So those work more. Gold's a safe haven asset. Platinum's more an inflation sensitive asset. So if you start to see platinum rip, that is further evidence that inflation is gripping the markets and the participants in the market. We've got Eric Nuttall. He says, calling all contrarians, not only is net length financial demand for oil at its lowest level in history, but the paper market for Brent is now net short the first time in history. All the while, physical global oil inventories are at or near all-time lows. What a setup. Now, I don't know if I'm supposed to be bullish here or bearish. I like the setup from the long side. In the very short term, that's a long-term view. In the very short term, I don't know what to make of this. Everyone is bearish. That generally means that I should be bullish on it. I should take the opposite bet, which I do. I am taking the opposite bet. But in the short term, could there be further downside? There could. There could before we get this big turn higher. So that's the difficult part here. We've got the yield curve uninverted. That is generally synonymous with a slowdown in the market. A slowdown, depending on how bad it is, it doesn't mean that oil demand goes down. We can have oil demand stay stable or go up even in a slowdown. Most times in history, I think it is the financial demand that really gets scared. And that's exactly what we're seeing right now. The financial demand is the net length has come out of the market, but it's now net short for the first time in history. And whenever everyone gets on one side of the boat, you want to jump on the other side first because these shorts could get squeezed. And what occurs, and I'll pull up a chart real quick because I think this is really important to see here. What occurs is that this is the slingshot cheetah that I talk about. We get a consolidation. This is your consolidation here. What everyone's going to say is that we should go short here and it's going to go down. That's not what I think. Your break-even costs and a lot of these high-cost producers are in this general area. So what I think we were doing here is bouncing off the highest cost producers in the system. What happens is they break it to the downside and it gets everybody short, aka it's now net short for the first time in history. Everybody gets short here, and that's what creates the slingshot. When people get short, it increases the buying pressure if they have to close their shorts. So if this comes back up, I don't know when it's going to do that, but if it comes back up, those guys are going to be buying and closing their shorts. That's the slingshot. That's what creates the big move to the upside. It's when it breaks to the downside, fakes everybody out, it becomes a false breakdown. And then everybody gets net short. First time in history. Then they rip it on them to the upside and they squeeze everybody in that play. Now, I'm not stating that that's the setup we have here because it's very difficult to know real time that you're in that setup. But it looks like it could. We'll see. And I don't know if this is the ultimate bottom. We could drift a little bit lower before that occurs. Maybe we come on down like this. But that's what the slingshot is. And that's what the data supports is that everybody's on the wrong, on the short end of the boat here, short side. Marion Katusa says commodities are cheap compared to the S&P 500. Commodities at cheapest levels ever since Nixon closed the gold-backed currency window. So we are the cheapest in this ratio. The question then becomes, why are we this cheap? What caused us to get here? Why is everybody over in the equity camp? I think it's the declining interest rate environment from 2008. Maybe it's all the money printing. Maybe it's the people putting money into the markets and not really paying attention to what's going on. They just dump into the S&P 500 every paycheck. Passive investing. Could be all those things. But I can tell you this, whenever we get to these really low levels and we get an inflection point to the upside, things could get pretty fun. Because you could have a very big move, much like the 2000 move. And you know what's even more crazy? When we had that first pullback, wave 2 here, this big move, that move, this move off the bottom of 2020 is nowhere near the same size as this move here when compared to equities. We have a long runway for equities to fall and for commodities to go up. Long runway. Andros, however you say his name, Andreas, we have honestly been caught a little wrong-footed by this rebound, and I still struggle to explain it with fundamentals. China may be stabilizing a bit here, or else it is just positioning squeeze. And it's a weekly rebound, with the BCOM-TR index rising 2.6%, driven by gains across all sectors led by precious metals. Key drivers including a general risk-on sentiment, a softer dollar, gold's technical breakout, crude short covering from oversold levels, and signs of recovering metals demand in China. You know why he's flat, wrong-footed here? I think it's because of the real estate market. I don't think the market is as weak, the economy is as weak as what most people think. A lot of people think that we're just going to crash crash and burn. I don't know if that's going to be the case. Maybe it's possible if there's some sort of bank liquidity event, something could come out of left field. It very well could. But right now, a lot of people are positioned. Maybe early is the case. Maybe they're just early and maybe we get a little bit more of a pullback later on. That's also potentially could still be the case. But generally, commodities, big pullback. And that's how people are already positioned. They're all positioned like that right now. If they're on the wrong side, they're all going to get squeezed. And we could see a big move to the upside in oil and other commodities if they are positioned incorrectly. If this market is stronger than what most people think. Oil, the Baker Hughes rig count, oil is up 5 and gas is up 3. So the rig count increased rigs. That's not too bad. That's looking pretty good. We've got oil here for Warren Pies. He says, hedge funds have now built a record net short gas oil position. Looking at crude and refined products, we are now basically at max pessimistic speculative positioning. Yeah, I just want to go long, guys. I really do. I mean, when you've got max pessimistic speculative position, everybody's on the wrong side. They're all on one side of the boat. Whenever everybody gets on one side of the boat, it's almost always best to take an opposite contrarian viewpoint. It doesn't mean that it will be right immediately, But if everyone's over there, at some point they're going to have to come back to the other side. Things get a little bit too lopsided. But I mean, maybe they know something that we don't know. I don't know. Maybe there's the Fed's got something planned in its back pocket to tank the market for a little bit. I just find that hard to believe. Christine says this is the most idiotic argument of the year for producing more oil today. Keep this up, and I'll write my own name as president come November. In inflation adjusted terms, oil is trading at $55 a barrel pre COVID. If it keeps trading like this, we'll start to experience bankruptcies and layoffs next year. And these guys, they keep talking about drill, baby, drill. They can't lower the price anymore. No matter what they say, they cannot lower this price anymore because they could do it for a temporary short term, like bring us into a recession or something. But sustainably, they can't keep it down here because you're underneath the cost curve of the highest cost producers. So if they try to bring it any lower, you're gonna pull back on supply and then bankrupt some companies. That very well could be the case. And yes, it could go down for a temporary thing, but they're saying like drill baby drill, like you could lower oil price when your break-even points for your swing producers are higher than what the price is. Brandon Balo says we have 92% of our portfolio in precious metals and mining stocks. Our actual risk exposure is much less due to stops, etc. But we're going for the jugular. Stay frosty. Well, that's his opinion there. I mean, you can do whatever you want. Concentration of portfolio can make someone a lot of money, but it is actually pretty risky. He says our actual risk exposure is much less due to stops. I don't know if that's the case or not, but okay. But yes, concentration can work very well. It can also go in the opposite direction. It can also go in the opposite direction. The tough part that I've gotten, and here's my experience. When you do heavy concentration, what I mean by heavy concentration, you start taking positions to 20% in a single position of your portfolio. I find that my resiliency is less. I am less resilient to market swings and volatility because I know that my position size is so big and I need it to win. If you do that with 92% of your portfolio in a single sector and you put large positions on individual companies, and I'm not saying he's doing this, but I'm just saying in general, that's where I get uncomfortable. You're not balanced in the portfolio. You can make a lot of money very quick. Don't get me wrong, and he's probably rightfully so. Doing this at the right time. You've got a breakout in silver. You can go into some of these companies, and the risk reward is very good. So I think he's got his head on straight here. I'm going to say I can't do it because I get uncomfortable with the volatility and having huge positions in a sector, and that's where I get uncomfortable. So my big positions are less than 92% of my portfolio in a single sector. Cross-border capital says more than 3/4 of the 350 billion rise in the U.S. M2 money supply in the past year has been monetization of the government deficit. 3/4 of the 350 billion rise here. Coming on down, rock bottom entries. Miners have officially broken out versus the S&P 500. A monumental shift of capital into the sector is underway. Here's your downtrend line. You've got a potentially inverted shoulder, head, shoulder, and a breakout that is coming right on momentum too here. What does that mean? Well, it also signifies that we're in a slowdown of the market. It also means that we've got an uninversion of the yield curve because they're all interconnected. They are all interconnected, and the S&P 500 can slow down, and gold and silver mining companies can speed to the upside. That's your breakout. It's a function of market conditions. Tavi says investors are currently long positions in WTI contracts in the last 10 years. I'm comfortable taking a contrarian stance on this. The possibility of servicing remains one of the most overlooked views in the market today. That is true. He is completely true on that opinion there. Everyone's positioned on one side of the boat, and I think they all think it's going to be deflationary and that things will crash. It very well could be. Now, here's the thing: if we can buy a cheap company in a cheap sector, and we know that it's cheap, and we're getting dividend yields on it, would I take that bet? I would. I would. Knowing what I know, I probably would. Now, here's the thing: could we go lower? Yes, we could. And what would I do if it went lower? I would hedge myself with time. I would be more patient than everyone else, and I'd hold on, and I would buy more. Those dividends that I'm getting from these companies, which is a very big sum of money, I can continue to pile into it and amass a even bigger position in them. Could my dividends get cut? They could. They very well could. And what if these people are wrong? What if we get inflation, which I think we do? We have inflation. What if to increase the M2 money supply due to monetization of government deficits, they continue to do inflation coming into the system? What if everyone is positioned wrong? They think, like the last 40 years of the declining interest rate environment, that bonds are the good bet, that we're going to get a pullback and things will go down in nominal terms. What if we don't? What if we continue to go higher and they are printing so much money that it overwhelms the slowdown or recessionary pressures in nominal terms? That's what I'll say there for my opinion. We could go up even though we are going through a slowdown in the system because of the inflation. And oil is the most inflation sensitive asset we've got. That's what I'll say. Gary Bohm, I did do a interview with Gary, so if you guys want to check that out, go for it. And then it looks like we got another post there. Francis says, from Scotia this AM, WCS, which is Western Canadian Select, differentials. Meg has 100% exposure to WCS, followed by a few other companies, which has the highest sensitivity among the large caps. And this is the Western Canadian Select up 3.1% today. So it looks like we're trying to bottom. I know oil was trying to bottom earlier. It probably didn't close the day up this amount. But this is one to watch, and I think there's some good opportunities here over the next, whenever this turns. The companies that have exposure to this are very sensitive to the price. Tons of leverage. That's where your swing producers are at. Here's platinum. Here's an update. It says the coil looks to have completed its count. So he does a count here. He's got an A, B, C, D, E. He's throwing the alphabet out here. It's kind of a 1, 2, 3 hump consolidation, perhaps. And maybe we can break out of this and start running in platinum. I would love for that. I'd love to have silver and platinum running together because I own a big chunk in both of those. So yeah, it looks pretty good. Here's myself again. It says ETF SILJ hasn't really started to outperform silver much yet. But when it does, it should be a very fun ride. SILJ will provide about 2 times the leverage to silver if it reaches close to all-time highs again. And we've broken through this downtrend where SILJ could start to outperform silver again. If we get to the highs up here, that outperformance of the silver junior ETF should be about 2 times the price of silver. So it's going to go twice as fast higher as silver does. There are companies out there that can do 3, 4, 5, 6 times the speed of silver. And you guys have seen my silver charts. I think silver could go up quite a bit. And some of these silver companies are very cheap in relationship to silver itself. And that's the same setup that I had with some of the companies in oil in September, October of 2020. It's the same setup. So yes, I've got a good allocation to silver junior companies and gold mining companies and stuff like that. And we have a lot of leverage to the upside here. Leverage also means that we could see a lot of volatility. So you gotta ride through the volatility when we go through this together here. May not be an easy ride. Here's the 2 and 10s yield curve uninverting, 2-year falling pretty hard. We're going below that 1-to-1 relationship. That's when the slowdown generally could occur. Here's another chart that I grabbed. He's got silver. The end is nigh or near, and there's the chart that he's got coming on up. And we might go vertical here and start to go way up in the 2020s and 2030s here, way up, way up. We also have a nice good cup and handle break. Here's your cup. There's your handle, and we are right at that breakout point. We close a yearly closing of above about $31 an ounce, which we're right at. This could get real interesting here because you're engaging this 45-year pattern. So this is what we've got. This is the base here. I draw this line going down this way. Then we have a breakout. This was also under an increasing interest rate environment, and I think it's there, guys. I think we're ready to go. This thing's ready to blow to the upside. Uh, yeah, if you need any help with anything, just come onto the website, ask questions. I'll try to help you guys with whatever I can. Lots of picks in silver that could go up dramatically under this. Dramatically. Hopefully change people's lives. It says, is everyone ready for the move in silver? Have your favorite silver stocks already? Question mark. Hopefully we close strong today. And we had a breakout. I posted this early in the morning, and there's your move higher. We did close quite strong yesterday, Friday. So that looks absolutely excellent. There's 2-year yield dropping, probably creating a higher low somewhere above the breakout point. And that's where I put the box. So we're probably coming down to this area of around 1.5%, 2%, 2.5%. It would be my guess that was where the 2-year yield could end up. So it won't go all the way back down to the lows. It'll create a higher low. And that's where we're at in the business cycle. That's where we're heading. Here's Terry Kim. I just wanted to make a comment on this. He says, I studied the morning routines of 50 billionaires, and not a single one mentioned cold showers, waking up at 4 a.m. He says, here are the habits that successful people actually follow. I want to make a comment here. These guys are all tech guys, all of them. They're all technology. Every single face that you see here, Google, Amazon, Tesla, Microsoft, Facebook, outside of Buffett, these are all tech guys. All tech guys. You got Larry there. If you were to take these same people and you were to grab them and put them in a different time frame, like you were to put them in the 1970s, did you know that none of these faces would show up? It's not the person that makes these guys the richest people in the world. It's a function of luck. And people are going to say, oh, no, it's not. These people work really hard. And this is the reason it's a function of luck. And unless they purposefully went into the area that they did. The business cycle and the credit cycle over-aligned, aligned on top of each other, where money flowed into technology companies. It was a function of the market conditions where all of this wealth and cash went into. So these guys were in the right sector at the right time. Back in the day, there were time frames where oil guys were the richest. It was all oil and maybe it was trains would be more of technology, but it was commodity based time frames like the 1970s, potentially earlier than that too. It was all oil guys and all that. I think that we are entering a period where this entire lineup is going to change into commodity companies and the CEOs and founders that have founded commodity companies or food companies or whatever it is. This is a function of time and the market condition that we went through. And these guys were in the right time, in the right place, in the right company, and those are the ones that made it. This will change based off of your market conditions, in my opinion. Here is Grady, big picture view. It says the big picture charts I post show a life-changing opportunity for the rest of this commodities bull market. Below is one of those charts. This one is showing Palladium bottoming out right here before it starts its bull run. And there's the 2,000% increase, 2,000% increase. And then we've got the third wave. I actually bought a whole bunch in '05, which was right here, and in '09 when it came back. I rode it all the way to about here in 2020, and I swapped it for another metal. But this looks good, and we could see another big move out of this. Looks very good. Here it is for HFI research, structural supply deficit. Here we go again. In essence, what Exxon is saying is what the oil bulls have been saying for years. Without new capital investment and discoveries, a structural oil supply deficit is coming. If global oil demand simply remains around 100 million barrels per day for the foreseeable future, the existing declines in oil fields will require companies to continuously invest to meet future demand needs. It is more dire than what you think. By 2030, because I read this, by 2030, the gap in, if no new investment went in, the gap between what we can produce and demand is 70 million barrels per day by 2030. It's a 70% decline from where we are today to 2030 that we need to replace. And you know what? I don't think we're going to be able to replace it by 2030. I don't. And I think oil is going to take off. And we're going to get an imbalance here. The imbalance is going to be between credit creation and oil supply. That's my opinion. So I'm hugely bullish, much like Exxon is saying here. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys are interested. I've got a bunch of oil companies too that I'm continuing to monitor and watch. We'll see if that's a false breakdown on oil, if we get a slingshot move in the opposite direction or not. But that's what I'm watching. I've got my favorite oil companies, and obviously we're looking at precious metals, mining companies, and all that as well. So we've got the question and answer session that's occurring at 7 a.m. to 11 a.m. ish, 7 to 10 a.m. Mountain Time. So if you want to join, it's happening today at Saturday. So I'll see you there. See ya.